organization has been drawing attention to the role of corporate power in inflation. Last April, we released a report, The Rise of Corporate Profits in the Time of COVID, that showed the profit margin of Canadian corporations had jumped significantly in 2021. From an average pre-tax margin of 9% over the previous 2 decades, the margin reached almost 16% in 2021. Preliminary data for 2022 suggests that profit margins remained elevated. Corporations are not just passing along higher costs. Many are taking advantage of turmoil throughout the global economy to boost profit margins. The big retail grocery chains, Loblaws, Empire, and Metro, have gotten much of the attention for food price inflation. This attention is absolutely deserved, as all three have had higher profit margins during the pandemic. But this goes beyond the public face of food retail. Grocers' costs include the profit margins of their suppliers. Therefore, when the grocer's costs are higher, some of that is likely paying for higher profit margins. At practically every step along food supply chains, there are corporations seeking the greatest possible profit. Some corporations will be able to pass along higher costs while preserving their profit margins, and some will pass along more than higher costs to claim even greater profits. Some of these higher costs and higher margins will be borne by small food businesses, such as neighborhood restaurants, because they are not able to pass along higher costs. However, much of these costs will be paid by students, pensioners, workers, and their families. In other words, everyone that needs to eat. Of course, workers also want to pass along increased costs with higher wages and salaries. Some may be able to do so, most will not. This is the step where central banks express concern about a wage price spiral. Yet there is no similar concern for a profit price spiral, even though one, most of the prices we face are set by for-profit corporations, and two, corporate profit growth is well outpacing wage growth. In fact, the Bank of Canada's monetary policy reports that justified its recent interest rate hikes make zero reference to profit. Let me mention the profits associated with fossil fuels, a vital input to all of our food at many stages of production. In 2019, Canada's 10 largest oil and gas companies had combined pre-tax profits of $8.5 billion at an 8.5% profit margin. In 2021, their margin doubled to 17%, bringing them a combined $23.8 billion. Oh, and while collecting these record high profits, 7 of the 10 paid no income tax. The question of who gets to pass along higher costs and who has to absorb higher costs and who gets to pass along more than higher costs is a question of power and redistribution. Currently, some of Canada's biggest corporations have a lot of pricing power, and unsurprisingly, they are taking advantage of it to the detriment of Canadians. I will finish by advocating 2 tax measures to address this situation. First, a minimum tax on reported profits. If we had a 15% minimum tax on the profits that corporations report to their shareholders, the 10 largest oil and gas companies would have paid a combined $3.6 billion instead of nothing. Second, an excess profit tax, which reduces the incentive to hike margins at every opportunity. The revenue from an excess profit tax could be redistributed to Canadians to help cover their increased costs of living.